Alright, today is Wednesday, November 10th. This is a recap of the stock market activities today. Folks, I got a good one for you tonight. Today was a wake-up call, a reality check for market participants due to the stunning number that we got from the CPI inflation, and therefore, let's dive right into it. In focus tonight, what else? Inflation, the story of the year and the story in everyone's mind. But before we do that, let's back up and do an update on the story from last night, the Evergrande story, because they all tie in together. The risks for the market right now, the default of Evergrande and inflation. We got the news today that Evergrande failed to make payments, coupon payments, for some bondholders. And so far, there is no official statement about the default. Crickets, but we know that at least $150 million was due today. And the fact that some bondholders did not receive payments, coupon payments, then this is a confirmation that indeed Evergrande has defaulted. And we're about to experience the ripple effects of that massive giant default. The dominoes are starting to fall. Of course, prepare to see a lot of fake news that Evergrande met their payments and Evergrande avoided default. This is all fake news. We already know what's going on here. It is just a matter of time. Because who's been bailing out Evergrande for now? It is coming out of the founder's pocket, and this is not going to happen for too long because the resources are limited. Either the Chinese government is going to bail out Evergrande or default is the only path forward. Even the University of Chicago is warning now. China's economy is hitting a great wall. Parallels to the '08 housing crash could unleash a major recession. And of course, if China falls, everybody else will fall. China is too big to fail. And here's what we got overnight. The Chinese factory gate prices, and they rose at the fastest pace in 26 years. Once again, the fastest pace in 26 years. So this was the first warning shot overnight. And of course, we have the transitory crowd who keeps saying, oh, but what about China? China is going to cause deflation. In reality, however, if you pull your head out of your ass, China is now a source of inflation, not deflation. And right away in the morning, we got the big bomb, the CPI, aka the CP lie, and even the cooks couldn't do the job here. U.S. consumer prices jumped 6.2% in October, the biggest inflation surge in more than 30 years. Once again, transitory, huh, Mr. Powell? And of course, market participants, the zombies that they are, they shrugged it off. And they bought the dip right away in the NASDAQ and the Dow. Well, guess what? These dip buyers, they got slaughtered today. In all likelihood, they're going to continue to get slaughtered. They're not going to stop, of course. They're gamblers. They're addicted to the gambling and buying the dip. They're not going to get the memo. They're going to get it after the fact, and we're going to see a massive slaughter here. And of course, the rise of the CPI primarily happening due to the rise in energy prices. And the Biden administration is now stuck between a rock and a hard place in a tough corner. On one hand, they continue to promise their so-called green agenda as the solution for energy prices rising higher. When the problem is the shortage of supply due to the horrific policies from the Biden administration against oil and gas producers in this country. Therefore, the domestic supply is down. And the reason is the messaging. The messaging is horrific. The administration says, we're not going to reward you at all if you start digging oil. However, if you're EV manufacturer, if you are windmill manufacturer, solar, anything so-called green, we're going to funnel billions, if not trillions, of taxpayer money to your business. But oil and gas, we're actually going to punish you. How do you think domestic producers will reply to this? And of course, the Biden administration is scrambling right now to solve the energy crisis. We're heading into the holiday season, the winter season, and heating bills will skyrocket. And therefore, this is emerging into a full-blown crisis. The only options that the Biden administration has is to release supply from the strategic reserve. The problem is doing so will be an equivalent of waving the white flag that we lost our so-called green energy push, fired back, and now we have to dip into the strategic reserve. Green energy might be the future, but the transition from oil and gas to green energy has to be gradual. You cannot shut down oil and gas altogether and punish them and funnel all the cash, all the taxpayer money from the government to so-called green energies. Not going to happen. It's going to take years and years. that infrastructure to be built? And even then, will it be sufficient to replace oil and gas? But prices across the board are surging higher. Take, for example, beef, pork, sausages, hot dogs, burgers, all surging higher as extraordinary inflation hits grocery stores. And now they're calling it meat inflation or meatflation because beef prices are through the roof. And this is, of course, choking American households, the poor and middle class. And you're not going to get any relief, by the way, from switching to vegan or alternative meats. For example, Beyond Meat. Matter of fact, the stock of Beyond Meat is crashing after hours by more than 17%. And the reason is they're lowering the guidelines. Why are they lowering the guidelines? The answer is pea protein prices are surging out of whack. Pea availability is challenged by an exceptional drought this summer in Canada, the largest pea-producing region in the world. This drought is probably the worst in over a century. Canada recorded a drop of 45% in its production, and pea prices have drastically increased by 120% in comparison to last year. Simultaneously, Europe has suffered from low yields, and in France, another large pea-producing country, the crop has been severely damaged by the wet weather during the harvest. And this is not going to end anytime soon, by the way. We have the worst drought in California's history. We know that California is the largest producer of food in this country, so food prices are going to continue to skyrocket with no stop in sight. It is not just the reckless monetary policy behind inflation. It is combined with the climate crisis and the shortage of water, creating this inflation superstorm. And this will get extremely dire because the lakes, the water bodies that we have in this country, be it Lake Oroville, Lake Powell, or even Lake Mead, they're all dropping like a rock when we talk about the water level. Take a look.
Lake Mead is vanishing before our eyes. It's at its lowest level in history since it was built in the 1930s. The last time the lake was at full pool, it was 1983. Now, it's in a countdown to dead pool. On June 9th, the water level of Lake Mead dropped below an elevation of 1,075 feet. On August 16th, a water shortage was declared by the U.S. Bureau of Reclamation, the first ever federally declared water shortage in history. It means Tier 1 water cutbacks go into effect January 2022. Arizona will be the most impacted to start, losing 20% of the water supply from the Colorado River. Households will need to start conserving water. Some farmers have already let fields go fallow or switched to less water-intensive crops. But Lake Mead dropping below 1,075 feet was just the first of 4 major milestones to watch. Tier 2 water cutbacks begin at 1,050 feet. Those will be more severe and will affect city centers like Phoenix. Benchmark 3 is when the turbines at the Hoover Dam will no longer work. That's 950 feet below 900 feet. Dead pool. That means no water can leave the reservoir. The Hoover Dam provides enough power each year to serve 1.3 million people across Southern California, Nevada, and Arizona, and help keeps the lights on in Vegas. Losing that clean energy is expected to happen by 2024, but the water level's been dropping faster than previously expected, and now that we're lower, it takes even less water to drop every foot. And it's not just Lake Mead that's vanishing before our eyes. In July, Lake Powell, further up the Colorado River on the Arizona-Utah border, hit its lowest level in over 50 years. About 40 million people rely on water from throughout the Colorado River. Water cutbacks will hit farmers first, then Native American reservations, companies, and big cities. Outside the Colorado River Basin, Lake Oroville in California already dropped to a record low. That shut down the power plant there for the first time in history. A glimpse of what's to come: shifting shorelines, relocation of marinas, water cutbacks, and a blow to hydropower. The new normal of America's West.
And if this continues, prepare for starvation. Prepare for the upcoming famine. We're not joking, by the way, when we say that. We're not looking for clicks. This will happen. The trajectory is for an upcoming famine, a major famine, a worldwide famine. Farmers are racing to adapt to climate change as the world faces a new era of rapidly increasing food prices that could push almost 2 billion more people into hunger. And even the Italians, we already talked about the French running out of baguettes. Baguette prices are surging out of whack due to the rise in wheat prices. And here we have the Italians, worried about the supply of pasta and pasta prices due to the rise in wheat prices. Can you imagine this? Italy is running out of pasta. This is like saying the United States of America is running out of Oreo cookies. And inflation doesn't stop with food prices. We also talk about real estate prices all the time. Nationwide, the median single-family existing home sales price rose 16% in the third quarter to $363,700 from a year before, the National Association of Realtors said. And by the way, good luck finding a home for $363,000. Maybe an Amazon box that you can place on the top of your head, and you call that a home. In California, you need at least $800,000 to get a decent home in a decent neighborhood. What about the labor shortage pushing wages out of whack? You're planning to fly this holiday season? Will prepare for havoc and chaos. Fist fights at airports, flight cancellations, and the reason is we have a shortage in pilots. Until we have self-flying planes, we need pilots, and pilots don't want to come back to the job for bonuses. They want permanent changes. They want higher wages permanently. So when we talk about transitory inflation, is this transitory? Of course not. These are permanent wage hikes, permanent benefits expansion that is not going to be transitory. And all of that extra cost will be passed down to you and I, the end consumer. Matter of fact, U.S. labor cost rose by 1.3% last quarter, the biggest increase since 1991. And before you start celebrating that, hey, inflation is good because our wages are going higher, hold your horses and hear the facts. Inflation has taken away all the wage gains for workers and then some. What are they talking about here? Real average hourly earnings, when accounting for inflation, actually decreased half a percentage point for the month. A 0.9% inflation increase negated a 0.4% rise in wages. Are you paying attention, Mr. Powell, or not? Of course not. We know that for sure. Consumer confidence has been sliding despite the rising wages, which are up nearly 5% nominally year over year, but have declined, underlined declined, 1.2% in real terms. The Fed finds itself under increasing pressure to adjust policy accordingly. No, they're not. No, they're not. They're delusional madmen and women, and perhaps criminal. To illustrate this for you, take a look at average hourly earnings. 4.9%. They're rising, but they're back pretty much at the same levels from 2019 pre-pandemic. Yet the consumer price index inflation is surging out of whack, 6.2% year over year, and the trajectory is higher and higher and higher. And remember this one? Gianna Smilyak, whatever the hell her name is? She was asking a few days ago, who's gonna win, inflation or wages? Maybe you have your answer, Gianna Smilyak. Now you got the answer. I guess they don't teach that kind of stuff at fancy schools like NYU, right? Meanwhile, the guy who went to public colleges got it right from the get-go. And no student debt either. What about the supply chain crisis? The ships stuck at the ports. Well, it's getting worse and worse and worse. The number of cargo ships waiting at the ports is rising higher and higher and higher. Remember when President Biden barked and said, hey, Walmart, UPS, FedEx, speed it up. Come on, man, speed it up. Well, they're not speeding it up because it's not up to them. The ports remain jammed. Matter of fact, the log for now, a record 111 container ships are floating off California's busiest ports, despite Biden's 24/7 schedule and looming fines. This is their approach, folks. Instead of solving the problem, they're going to fine these ships. What do you think will happen to these fines? That cost will be passed down to you and I, the consumer. Absolute delusion. And perhaps you want to sprinkle a little bit of criminal activities with that, because here it is. Newsom, remember, our absentee governor Newsom, and Buttigieg, the absentee transportation secretary, well, both of them cooked a deal here worth about $5 billion in loans for California's clogged ports. Here's the problem. The money won't help unclog the severe congestion that is creating seaport chaos at present, but the two say that modernizing the ports and the truck and rail systems that serve them can prevent logistic nightmares in the future. What are they talking about here? What the money would be spent on remains vague. The California State Transportation Agency listed port upgrades, more freight rail capacity, increased warehouse storage, truck and rail electrification, highway upgrades, and other general categories as possibilities. I don't know, this sounds fishy. A little bit of corruption, right? Instead of solving the problem by decreasing the out-of-whack demand fueled by monetary cocaine all over the place, they want to throw more money at the problem. And 99% of that money will go into the pockets of donors governors, billionaires, and bureaucrats. And by the way, our absentee governor, Kim Jong-un Newsom, suddenly resurfaced. Where did he resurface, you might ask? Well, at a spoiled brat billionaire wedding. That's where. Some spoiled brat had a wedding, and all of a sudden she dragged all of our politicians, including Nancy Pelosi, by the way, who officiated the wedding for the spoiled brat. Nancy Pelosi can hop on a plane to attend the spoiled brat's wedding, but she did not pass infrastructure, she did not pass any aid to small businesses, or anything to benefit you and I, the taxpayer. Nothing. Good luck getting a meeting with Nancy Pelosi, even if you are one of her constituencies. They're not going to answer to you, but they answer to the billionaires right away. I mean, you look at this image and it looks just like before the French Revolution. Out of touch, out of mind, living in their own bubble, unattached to reality. The reality of inflation, surging prices, hitting the poor and the middle class. That doesn't matter to them. But some spoiled brat billionaire's daughter or granddaughter, she gets married, and the marriage will probably last for about 2 years anyways. And your beloved politicians, your dear leaders, have to answer right away. This is who they serve. It's all about the money, baby. It's all about the money. No wonder why Biden's approval numbers are dropping like a rock. The worst numbers in presidential history. When voters are asked, do you approve or disapprove of the job Joe Biden has done as president? 59% disapprove. And it gets even worse for the Vice President Harris, the absentee vice president. Only 27.8% of voters approve of the job she has done. What job? The least popular vice president in American history. Even less popular than Dick Cheney. And when voters are asked, do you hope that Joe Biden runs for another term as president in 2024? A stunning 63.7 say, you know what? No. Only 29% of Americans say, yep, we're going to vote for the same disaster again. And here's the problem. When voters are asked, do you hope Donald Trump runs for another term as president in 2024? 35.6% say yes. Let's swap one senile with the other. This country is doomed, folks. And now the majority of Americans blame Biden for the rising inflation. And I told you, they're not going to blame Powell. The majority of Americans don't even know what the Fed is or who Jerome Powell is. They're going to blame it on the top dog at the White House, who happens to be Joe Biden right now. And therefore, I told you, the biggest political enemy for Joe Biden right now is Jerome Powell. Yet he wants to re-nominate him. Wow. Before, Americans were buying the story that this is just a temporary spike in inflation, a transitory spike due to the reopening and returning to pre-pandemic behaviors. This is not happening anymore. Matter of fact, 62% of voters now say that the inflation we're having right now is due to the Biden administration's policies, up from 59% back in July. Stunning. Absolutely stunning. And it's going to get worse and worse and worse. And the reason is, the experts over at CNBC and Wall Street, the media, they continue to say, yes, inflation is bad, but the economy continues to thrive. We have a growing economy. The consumer is flush with cash. The consumer continues to spend. This is a roaring economy. When the facts say the consumer was strong due to the Coke, the stimulus. Well, the stimulus is gone now, and the consumer is dipping into savings now. When Jerome Powell says we're not going to have any crisis like before, the financial crisis in 2008, 2009, because debt levels are stable, but they're not stable anymore. Consumers spent the stimmies, they saved a little bit, now they're dipping into their savings. Debt levels are rising again. A recipe for disaster if the Fed is forced to raise interest rates abruptly and perhaps more aggressively the market participants and the experts, quote unquote, are expecting. Consumer inflation expectations are surging out of whack as the CPI also continues to rise. And let me fix this one for you. Here it is, the projection to the moon. Shortages show little sign of easing since last month. We're talking about October versus September. What you want to see here is the blue ball should be ahead of the green ball, I guess, or aqua. Well, anyways, we're seeing this only in new cars and trucks. We're also seeing it in home appliances and motorcycles. Wow. Let them eat motorcycles. Everything else, these shortages are getting worse. When consumers are asked about buying conditions, they respond negatively. Matter of fact, this is the steepest drop on record when it comes to buying conditions according to consumers. Consumer sentiment remained low even after the Delta surge. The Delta wave is over now, yet consumer sentiment did not recover. And the experts, of course, told us, yeah, consumer sentiment is down, but this is all due to the rise in Delta cases and the Delta wave. Wrong. The real reason behind the dive in consumer sentiment is buying conditions and prices surging out of whack, aka inflation. But they continue to ignore inflation as a non-issue and blame it all on COVID. When consumers are asked about their gas and electricity spending, nearly 3 out of 4 Americans say gasoline and electricity are important budget concerns, and it is a top budget concern to the poor and the middle class. For example, those with earnings less than $50,000 a year, 42% of them say that gasoline prices and gasoline spending is a top budget concern, versus only 23% of those earning over $100,000. Likewise, when it comes to electricity, those earning less than $50,000, 42% of those say that electricity spending is a top budget concern, versus only 21% for those earning more than $100,000 a year. Yet the Federal Reserve, led by delusional madman Jerome Powell, say this is an inclusive recovery. Out of touch, out of mind once again. When consumers are asked, how are you going to shop this year for the holiday season? Online, in-store, or both? Hybrid. The overwhelming majority say online. The problem is, by the time your goods arrive, Christmas will be already over. On the other hand, we still have Russian Christmas. You can celebrate that by the time your goods arrive. Look at the bright side. Come on, man. Matter of fact, at least half of all consumers have faced issues with delayed or out-of-stock items. When consumers are asked, how concerned are you about future gasoline prices? The majority say, very concerned. And here is another disaster, by the way. About 1/4 of holiday travelers still have not booked their tickets. What are you waiting for? Prices are not going to get better. If anything, they're going to get worse due to the shortage of staff. And here's another one. More than half of all consumers have not started their holiday shopping yet. Consumers are still waiting for the so-called transitory inflation to be over. Well, hello. Time to wake up. It is not transitory, and it's not going to get better either. Prices will continue to surge out of whack. So far, we talked about inflation rising across the board for pretty much all goods and services. We also talked about the state of consumers, the downbeat sentiment from consumers. We also talked about the climate crisis, exacerbating the shortages and food prices higher and higher and higher. And now, finally, even the bond market is taking a note that inflation is surging out of whack and out of control. Matter of fact, market participants are now expecting the first rate hike from the Fed as soon as July. It was December, they pushed it back to September, to August, to July, and next thing you know, to February, and hence the abrupt surprise interest rate hike that will crash the economy and the entire stock market. Matter of fact, today, the auction for the 30-year bond bombed. It was absolutely horrific. And the reason is investors are now expecting higher rates. If interest rates start to surge higher, this will be the final nail in the coffin for the stock market and this economy. And even the break-even rates are surging higher in expectations that the Fed will move faster to respond to the latest CPI reading. I don't think the Fed will respond faster. I think that the Fed will be forced to respond faster because the criminal organization we call the Federal Reserve continues to be in absolute denial and delusion. Take, for example, San Francisco Fed zombie Daly. Even after today's reading, she continues to deny and beat the drum that this will be transitory and there is no need for the Fed to hike interest rates. Take a look.
We do have to talk about inflation. And it's not often you can celebrate economic history. But today is one of those days because given this morning's CPI, we are now looking at a real yield of roughly negative 6%, which is lower than we got in the 1970s. Does that tell you that we have a problem?
Well, certainly we have a challenge right now. Inflation is higher. It's eye-popping, right? It catches people's attention and it hurts their pocketbooks. The issue, though, is that we still have COVID.
Yeah, inflation is bad. It is hurting your pocket. But toughen up, buck up, lower your expectations anyways, because COVID is a code word for them, an excuse to continue to use to initiate the largest wealth transfer in the history of humanity, from the poor, the middle class, all the way to the 1%.
You go out and talk to people around your district and you say transitory. What kind of look do they give you?
Well, they ask me what it means. They actually don't have a a hateful response or I don't believe your response, they say, well, what do you mean by that? And I think that's a great question. What do we mean by transitory? Really, what I mean is that not expected to persist at these same rates once COVID is behind us.
Yeah, and COVID is not going to be behind us, you delusional mad person. It's going to continue to go on and on and on. They're going to find a new variant, and they're going to blame it on people not getting the jab. And even after everybody gets the jab, they're going to blame it on the people not getting the boosters. And it goes on and on and on. In the meantime, you people are initiating the largest wealth transfer in history.
And that's a very different answer than a number of months and things. I think the other thing that's really important is you have to recognize that even if it lasts only for a year, it's painful. It hurts, right? You pay more for fuel, more for food, more for your housing, rental or purchasing, and it hurts your pocketbook. And that's important for us all to recognize. It's a challenging time. It's a difficult time.
No, it's not a challenging time for you and your buddies. It is a challenging time for the poor and middle class that you people don't care about. Listen to how out of touch she is. She acknowledges that inflation is choking poor and middle class people, the average American. But she says, you gotta buck up. You gotta be patient. Why? Why are you not responding right now?
With real yields at about -6%, you're still really stimulating the economy. Financial conditions get looser all the time. Does this change your calculation for when you might have to raise rates?
Well, I think right now it would be premature to start changing our calculations about raising rates. We're certainly data dependent, but really we're still focused on as COVID goes, so goes the economy. And the higher inflation readings certainly have my attention. I'm watching inflation expectations as well. That has my attention.
Again with COVID, complete delusion, folks. They just don't care. They don't give a damn about you and I. They respond to the billionaires, the 1%, their pimps, their donors. That's who they respond to. And you want to talk about being out of touch? Listen to Fed Zombie from Cleveland. Mister, take a look.
And yet inflation is running pretty hot, hotter than most people expected and lasting longer than most people, including you guys at the Fed, expected. Have you stopped using the transitory word, or have you changed the way you've thought about how long and how persistent this is going to be in our economy?
Yeah, inflation is funny. It's so funny. We told you it's going to be transitory, and it turns out it's not. Whoops. Everybody makes mistakes once in a while. And if you thought that was absurd and outrageous, take a listen to the response from Energy Secretary Granholm when she was confronted on her plans to reduce energy prices.
Let me cut to it if I may. In Sturgis, Michigan, it is $2.89 a gallon. I guess that's better than in California. What is the Granholm plan to increase oil production in America?
Oh my God, that is hilarious.
That is hilarious, she says. You people are paying more for gas? That's so funny. That's so funny. It's hilarious. And the reporter, instead of holding her feet on fire, he starts schmoozing with her. The color of your jacket, it's green, it's whatever. But the other reporter, John Farrow, credit to him, of course, bravo, he wasn't buying it at all. He cut them off, and listen to what he said.
Those of you on radio today, and John Farrow, I must note that the former governor of Michigan is wearing East Lansing green today. That's what the color.
How reliant are we on OPEC Plus? I do wonder, and I don't think it's funny.
Bravo, bravo. I don't think it's funny. It's not funny when people are suffering with higher food prices, higher energy prices, higher shelter prices. It's not funny. But these are your dear beloved leaders. Out of touch, out of mind. They're living in the bubble of serving the billionaires. And that's all there is. And I say in this program that Fed Chairman Jerome Powell must resign immediately. He wasn't just wrong, folks. Even when it became clear that he is wrong and inflation is about to surge out of whack, he failed and refused to act. He doubled down on his stance instead. And because of that, average Americans are getting choked this holiday season. Enough is enough. And with that, ladies and gentlemen, let's move on to the markets coverage today, starting with the market's performance. And here we go. The Dow Industrial Average closing in the red, down 240.4 points, or a decline of 0.66%. The Nasdaq down 263.80 points, or a decline of 1.66%. The S&P 500 also down by 38.54 points, or a decline of 0.82%. What about the sector's performance today? Leading the pack, capturing the gold, silver, and bronze. The only sector of the market closing in the green today is utilities. And honestly, utilities shouldn't be rallying today because yields popped higher. Besides that, every other sector is down, led by energy, technology, and communication services. And what about the advance to decline ratios? For the NYSE, 38% advancing versus 60% declining. The NASDAQ, 28% advancing versus 68% declining. Awful breadth, of course, but every time we see these suppressed numbers, these exaggerated numbers to the downside, usually, not always, we see a rebound in the following day. Now, is it going to be a sustainable buy the dip action, or should you sell the rip? The answer to that question is in yields and the dollar. If yields continue to move higher along with the dollar, then whatever rebound we're about to get in the morning is an opportunity to sell. Sell the rip. If yields move down and the dollar perhaps moves a little down, then it will be a dip to buy, at least in certain sectors of the market. Moving on to futures. What's going on here? Energy prices are down. The WTI down over 3%. Brent down almost 2.5%. Gasoline down. Heating oil down. Natural gas is down. This is all, of course, due to two reasons. Number one, the pop in the dollar, but most importantly, the so-called response from the Biden administration. They're noticing prices rising higher, and they're playing a game of psychology for now. If we issue threats and plans to reduce energy prices, that might help in the short term. But if the market realizes that the Biden administration is bluffing, they're not going to release the strategic reserves, for example, then oil prices will pop higher again, and this will be a dip to buy in energy prices. What about softs? What's going on here? We have losses for OJ, lumber, and sugar all down, along with cotton slightly. Then we have coffee futures on the flat line, while cocoa futures, the only outperformer today in softs futures, rising by about 2% today. Moving on to metals, what's going on here? The dollar is popping higher, but so is gold, silver, platinum. What's going on here? Copper is the only one trading down. Is copper lying, or is it a fake out for gold, silver, and platinum? We know the dollar is trading higher. Yields popped higher. These are all hostile conditions for metal prices, specifically gold and silver. I believe that once the CPI print was out and everybody was shocked, certain traders and investors bet up the price of gold higher. Once again, we have no proof whatsoever that gold is indeed a hedge against inflation. It was in the 1970s, but not anymore. Since 1980, gold has been in an inverse relationship with yields. Yields go down, gold rises higher. Yields move higher, gold drops down. So we'll see who's telling the truth here. Is it gold or copper? Let me know what you think in the comments. What about meat prices? Live cattle futures on the flat line, while we have losses here for feeder cattle futures. On the other hand, lean hogs futures rebounding higher from the losses from yesterday. And here it is, grains lining up green across the board. A lot of you are asking me today, what is the hedge against inflation? What do you buy if inflation is about to surge out of whack? Well, if yields also surge out of whack, then stocks, no go. Certain stocks, maybe, but the majority of the market is tied via ETFs. And if the big guys go down, the entire market goes down. We know gold is not reliable, at least for now. BTC is not reliable or proven, at least for now. The only reliable hedge against inflation is food. We have a massive shortage of food. Combine the reckless monetary policy with the climate crisis, the drought, the scarcity of food. Food prices will continue to surge higher. You gotta go down to the source. Grains, futures is an example, and therefore we're seeing everything rallying higher today. Soybeans, soybean meal, soybean oil, corn, wheat, rough rice, oats, all moving higher, with the only exception is canola futures taking a retreat today. Moving on to the options market, the big casino. What's going on here? The hottest table is Ford, of all names, with about 1 million contracts exchanging hands today. About 76.5% of those were calls. And at number 2, Tesla, with about 1 million contracts. About 51.5% of those were calls. And at number 3, AMD, with about 800,000 contracts trading today. About 65% 84% of those were calls. They continue to buy the dip in these names via call options, and they buy them for the weekly, by the way. Moving on to the unusual activities that took place in the options market today. Not a lot of them, by the way. Options bettors remain shy. When the market starts to trade down, we see trades with 2-3 days till expiration, small amounts. You're not seeing these big bets anymore. But here we have the ticker RBLX for Roblox. The name popped higher after earnings. We're seeing massive short covering in this name, and somebody's betting that the short covering will resume by the end of the week, and therefore they're opening a call spread. They're buying the 105 calls, and they're selling the 110 calls, all for the expiration date of this upcoming Friday, November 12th. They paid about 50 cents for the 105 calls, and they received about 25 cents in premium from selling the 110 calls. All in all, the entry cost was 25 cents a piece and costing them $1 million. What about the trade for the ticker LOW, Lows? They're buying calls here, the 245 calls for the expiration date, you guessed it, this upcoming Friday, with expectations that LOW could pop higher by more than 5% by then. They paid about 17 cents a piece to enter this trade. All in all, spending about $400,000. And what about the trade for the ticker BA Boeing, the flying coffin? They're buying calls here, the 250 calls for the expiration date, November 26, with the expectations that BA could pop higher by more than 14% by then. They paid about 69 cents a piece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker NVDA, NVIDIA? Somebody's calling the top here. The name is trading down today, and they're doubling down on these puts by buying the 280 puts for the expiration date this upcoming Friday, with the expectations that NVDA could drop down by another 5.5% by then. They paid about $1.15 a piece to enter this trade. All in all, spending about $1.5 million. What about the trade for the ticker SPY for the S&P 500? They're buying puts now, the 432 puts for the expiration date, December 3rd, with expectations that the SPY could drop down by more than 7% by then. They paid about $1.40 a piece to enter this trade. All in all, spending about $1.5 million. And lastly, at the bottom of the table, what about the ticker DASH, DoorDash? They're buying calls here. The name popped out after earnings, and they're betting that a lot of shorts will continue to cover. They might be true, by the way, because I covered my Dash shorts today. I should have known better, by the way, because half of the revenues came out of my pocket. But anyways, they're buying the 230 calls for the expiration date this upcoming Friday, with expectations that the name could pop higher by more than 6% by then. They paid about $1 a piece to enter this trade. All in all, spending about $1 million. Moving on to the heat map analysis. What's going on here? A bloodbath in the northwestern side of the market, meaning technology, growth, momentum, not working today. And the reason is inflation data, yields popping higher. Also energy getting whacked, perhaps in anticipation of a response from the Biden administration. We have gold working in materials, but not copper, not steel. So the inflationary stocks are not working either. What is working in this market? Forget about the earnings pops. What is working here? The answer is healthcare and consumer defensives. Specifically, we're talking about the big giant names, the big pharma names, and the consumer staples, Procter & Gamble, Kimberly-Clark, Clorox, Coca-Cola, PepsiCo, Mondelez, Hershey's. These are the names that could withstand this inflation storm. They have the pricing power, they're exercising their pricing power, and the consumer is responding positively, at least for now. In healthcare, it is the big pharma names working. Forget about biotech, for example, Moderna down again today because we have German authorities not recommending the Moderna shots for those under 30, and therefore you're seeing Pfizer and BioNTech popping higher. Another secret section of the market that continues to work, and it is an inflation hedge, by the way, is garbage. Yep, garbage, waste management, all of these names are pretty decent as an inflation hedge. It doesn't matter, recession, depression, inflation is even better because we have more garbage than ever. Moving on to charts, starting with the 30-minute chart of the SPY, the S&P 500. What's going on here? We had the bear flag, the gap and crab, the head and shoulder formation. It doesn't matter to me. Multiple formations indicating that the SPY is about to trade down. And indeed it did. But now it is a little overstretched to the downside in the short term, of course. Look at where the RSI is trading, for example, from a 30 minutes perspective. Way oversold. The likelihood is we could see a pop. It could happen overnight. It could happen in the morning. And the resistance will be around 466. In all likelihood, we will see sell the rip in the morning. And here is a daily chart for the SPY, the continuous contract. We talked about the momentum indicators being overextended, but that's not going to tell you when to buy or when to sell. It's just going to tell you this is a sell zone. They have yet to reverse, at least in the MACD. We don't have a crossing to the negative side or any red impressions on the histogram. But the volume is surging on the downside, meaning we're just seeing the beginning of the selling. The market might catch a break from intraday oversold conditions for now. Perhaps we have Veteran Day tomorrow. We're not going to see a lot of selling, and therefore the market catches a break. But if yields continue to trade higher and the dollar continues to pop, sell the rip. Moving on to a 30 minutes chart for the Qs, the Nasdaq, what's going on here? It is the same formation with SPY, the bear flag, the head and shoulder, doesn't matter to me. It went down all the way to the support zone. The market opened gapping down. We saw the dip buyers right away rushing Naruto style, heads first, blindfolds on, buy first, ask questions later. Matter of fact, don't ask questions at all. And the dip buyers got slaughtered today. Why? Because the dip buyers don't watch the analysis from the Maverick of Wall Street. You should have waited till the support zone before you buy the dip. The RSI indicator overstretched to the downside, indicating we should have a rebound, at least in the morning or overnight, but this rebound will not last so long as yields continue to trade higher. Moving on to a daily chart for the continuous contract on the Nasdaq, what's going on here? We're seeing the beginning of the flush down. The volume is surging higher on the downside. The momentum indicators are curling downward from highly elevated levels, meaning that the reversion to the mean will be extremely painful here. Perhaps it will flush down all the way to the support for around 15,000. It looks like a long shot for now, but if yields continue to move higher, let's say 1.6 again, 1.7, then you're going to see the Nasdaq flushing down easily to 15,000. But we're not going to crap our pants yet, and the reason is when we look at the weekly chart for the NDX, everything is working according to plan. Even if the NDX flushes down all the way to the end of the channel, the lower end of the channel, the market is still fine. The moment the chart breaks the lower end of the channel, then we get a problem. And what about the IWM 30 minutes chart? What's going on here? Also fading away. The problem is, and my concern to be honest, what if the pop we saw in the IWM is fake, phony, and was due to the options, market activities, and the mechanics of the market? What am I talking about? I'm talking about the Russell 2000 from a weekly chart perspective. It is breaking out from the consolidation zone for the first time since the beginning of the year. I have no reason to doubt the breakout higher, but is it phony? Was it phony? We will know the answer to that if the rut closes the week below 2,360. If that happens, then we know for sure it was fake. Moving on to the dollar. The Dixie, what's going on here? Exploding higher, past the resistance. And we're not going to name a new resistance line until we get a confirmation of the US dollar trading above 94.7 again tomorrow. If that happens, then we're going to place a new resistance line, and you're not going to like it, by the way, because when the dollar continues to pop higher, it is not good for the equities market. What about gold? What's going on here? Be careful of a phony breakout. Gold should not be rallying higher if both the dollar and yields popping higher, unless market participants finally reversing the course and saying, you know what, let's go back to gold. What worked back in the 70s, the inflation back in the 70s. Gold went higher, so I'm thinking gold might go higher again. If that is the sentiment, then gold moves higher. Because I told you, it doesn't matter whether it's gold, whether it's BTC, any crypto, any garbage. Dog shit, doesn't matter. If the guy next to me and the guy next to him, if all of us believe that whatever is a hedge against inflation, then it is, because we're all going to buy it. We're going to move our money from the equities market to whatever the hedge against inflation. Is it gold? Is it crypto? Is it horse manure? Doesn't matter. But I won't jump in here and buy gold until and unless both the dollar and the 10-year yield cool down. Speaking of, here's the chart of the 10-year yield popping higher. Is it going to reverse the negative divergence on the RSI and MACD indicators? If it is, then watch out here. It's going to be mad because it's going to surpass 1.7 again, and that will not be fun for the Nasdaq. We had the head and shoulder reversal. What if we're seeing right now the reverse head and shoulder and yields are about to pop higher? Look, the debate remains intriguing from both sides. Those who believe that yields will pop higher in response to inflation because the mechanics of the market work that way. When the Fed, the sugar daddy, who's been propping up the bond market via purchases, when they ease their foot from the accelerator, off the accelerator, bond prices should move down yields should move higher. This is the logical argument, of course. But there is another side, another argument that says, well, if the Fed moves their foot off the accelerator and they start tightening by removing the so-called accommodations from Wall Street and the market, then the economy will slow down and perhaps dive into a recession, and therefore yields go down. The debate is still going on. When the stock market moves higher, only the 1% and very few of us reap the benefits. But when the stock market crashes because the Fed is tightening, all of us feel the pain, because the moment equity prices go down, companies will start firing people, specifically the recently hired. Those with higher wages, they're going to go fast. So when the Fed says maximum employment or substantial further progress when it comes to employment, baloney, you spent trillions of dollars to achieve so-called maximum employment. And the moment stocks trade down, all of these jobs, poof, gone. So much for a so-called recovery. Moving on to the TLT weekly chart, what's going on here? Still hugging 149. It was a negative day, erasing a lot of gains for the TLT, but it is still hugging 149. As I told you, the debate is still alive, and both sides have an intriguing and logical argument. Who's gonna win? I don't know. You know what team I'm on right now. It is the team that says yields are gonna pop higher, TLT will go down. Could I be wrong? Of course, because the other argument is extremely persuasive. What about the VIX 4 hours chart? What's going on here? It touched 20 almost today, and then it pulled back. What does that mean? It's not over yet. The VIX will give it another shot, and it might crack above 20 by the end of the week, and this will be a major win for market bears. Now understand this. Let's say you wake up in the morning and the SPY is trading higher, a rebound day, whatever you call it, but the VIX is still trading in the green, and oh, by the way, the MACD indicator from a 4 hours perspective is still trading in the green and moving higher. That is your sign right there and then when you combine it with the 10-year yield, if it is trading higher and the dollar trading higher. If this dynamic is playing out in the morning, then you know for sure that whatever rep we have should be sold. And the opposite is true, of course. Moving on to Apple, what's going on here from a daily chart perspective? It was the battle between options bettors and the bear flag. We now know that the bear flag is winning, at least for now, because Apple lost 150 as support, and we have a crossing to negative territory in the MACD indicator on the daily. Now, if the weakness continues, we have 145 for support. If that fails, then the original projection for Apple to go down to the lower end of the channel in yellow will happen. That will be the next support. I cannot give you a number because it depends on when Apple revisits the line. Moving on to Tesla, the souffle daily chart. What's going on here? It is rebounding higher, even in face of inflation rising higher, yields popping higher, which will eat away valuations, by the way. And even after the CEO says, look, I'm going to dump shares here. Even with that, they continue to buy the dips, buying call options in hope that Tesla will go to the moon. There is no logic here. It is a cult, and the only way they're going to understand it's over is when they lose all their money. You might see a rebound here, a combination of call options buying and short covering those who are taking profits right away. They don't want to continue to be short. That could move the stock a little higher. But at the end of the day, Elon Musk is just starting to sell. Number one. Number two, if yields continue to move higher, the companies with the highest valuations, the companies with the highest multiples, these are the companies that are going to get hit the most. And Tesla is the poster boy for higher multiples and overvaluations. I wouldn't be buying here, folks. I would love to see a flush down all the way to the trend line. And if it produces overextended RSI and MACD levels, then I will buy call options in anticipation of a rebound. Moving on to BTC, what's going on here in tulips? Reversing down, but yet holding the support of 64,899. The problem is, believe it or not, perhaps the gold bugs are staging a response here, a surprise attack against tulips, specifically BTC. If gold continues to pop higher, aggressively so, you bet a lot of money will be taken away from BTC to chase gold. Could it happen? Will it happen? Let me know in the comments. But for now, the energy remains in the crypto market. They continue to believe that this is the inflation hedge. And if everybody thinks that, then it will be. But if there is an alternative, an old school, proven alternative, the 70s, and it continues to pop higher 1%, 2%, 3% a day. The money will chase gold because the momentum will shift from BTC to gold. And lastly, what about AMC 30 minutes chart? Not good here, losing the support of 39. We're eyeing 36.5 now. And we have bad news after hours because CEO Adam Aron is dumping his shares. And he says this is estate planning for his 67th birthday. I say, you know what? Adam Aron won the lottery. He was about to retire and become homeless when AMC was set to be bankrupt. But thank you to the retail geniuses, they saved AMC, they pushed it to the moon, and now the executives are cashing the jackpot, the lotto ticket that they won. What happens to retail? The answer is they lose their money because AMC did a lot of good here. They tried to cater to the crowd and restructure the company, but it is a dying business. You cannot rescue it. As Gordon Gekko would say, it is wreckable. And that's that. It is sad because who's going to pick up the theater business? It's going to be Amazon, Netflix, Disney, the big guys. Theaters will be pretty much the service for Netflix or Amazon. I hate it. I want to save AMC, but it is not realistic. Period. Full stop. And you will see that this retail mania pushing stocks out of whack, out of valuations, it is the best gift for Wall Streeters and corporate insiders, be it Elon Musk cashing billions of dollars in fake money, be it Adam Aron, be it any other executive. And therefore, we continue to say in this channel, are you participating with discipline, logic, and defined goals? Or are you just YOLOing and getting involved in cults and cheerleading for stocks? Guess what? These stocks don't love you back. They don't even care about you. Your goal is to make money. And that's all there is. Your goal is not to hoodle to the moon or forever. You get in, you have a fundamental and a technical thesis. You reach your goal, you take your profit, and you move on. Speaking of moving on, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? Nothing. We have Veterans Day. We don't even have anything on the earnings calendar. We had plenty of earnings today after the bell, and the most important name is Disney. Disney is down big after hours, and this will impact the Dow Jones negatively. Now, before I sign off, an important note, we're not going to have a show tomorrow because I have other obligations, but I will be tweeting, so you might want to follow me on Twitter. But besides that, this is all I got for you for now. Thank you for watching. Thank you for listening. And I will talk to you again, not tomorrow, but in all likelihood, Friday. Take care. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.